Welcome, my friends, to another edition of the Heritage Wealth Planning YouTube channel. Today, I want to talk about the RMD tables from the IRS Publication 590. RMD is required minimum distributions. Many people don't understand this, and that's not good. You need to understand it because if you screw it up, the IRS is going to smack you with a 50% penalty on the amount you neglected to take out. So ignorance of the law, as you know, is no excuse. Well, ignorance of the tax code is certainly no excuse when it comes to paying taxes. Now, the interesting thing about the RMD table, let me get my mic up a little bit, is that it's actually quite easy to understand once you know what to do. And that's what I'm going to share with you today. So basically what I've done, or not basically, literally what I've done is I've gone to IRS form Publication 590. You don't necessarily need to remember that. But in Publication 590, Table 3 is your traditional or your typical required minimum distribution schedule. And that is based, once you hit 70 and a half, how much are you required to start pulling out of your IRAs and 401ks and 403bs and whatnot. Now, when I say traditional, I don't mean in the context of traditional IRA versus Roth IRA. I just mean in the context of traditional, what most people refer to when they ask about how much they have to take out as distributions from their retirement accounts. And so you'll see IRS IRA required minimum distribution worksheet. And I'll put a link to this in the show notes as well. Let me see if I can't make this bigger. Hey, look at that. Look at that. Technology is wonderful when it works, and it is awesome when it doesn't. Use this worksheet to figure out this year's required distribution, required withdrawal from your traditional IRA unless your spouse is a sole beneficiary of your IRA and she is more than 10 years younger than you. We're not going to get into that right now. We're just going to get to the typical case. I am 70. My wife is 66. I'm about to turn 70 and a half by the end of the year, and I need to take a distribution out of my IRA to satisfy the IRS requirements. Now, some people say, oh, don't do that. You can wait till April 1st of the following year. No, don't do that. I cannot tell you how many people do that. I'm going to get one more year of tax deferral. No, the reason being, yes, you could. So if you return, it's the year after you return 70 and a half. So I was born in 1970. I'll turn 70 and a half in 2035. Wait, 35, 2040, I guess. Yeah, 2040. Which means I can take my first RMD by April 1st of 2041 because that will be the year in which I have 6 months after I turn 70 and a half, if that makes sense. It doesn't make sense. There's no rhyme or wrong for the right or wrong for this. It's just what it is. Just don't do that. And here's why. If I wait until 6 months after I turn 70 and a half, April 1st of 2036, I'll have to take my IRA RMD for that year, which would be the previous year, but I can delay it until the following year, if that makes sense. And on top of that, that same year. So I have to take two required distributions in the same year. I know that's confusing as all can be, which is why I don't do that. Just take your first required distribution when you hit 70. Forget everything else. I don't care. Every year when you hit 70, start taking your required minimum distributions. I'm just telling you, don't double dip on required minimum distributions. I'm going to defer it for one more year. So that way I have to take two RMDs the following year. That's just going to increase your taxes most likely. Don't do that. So let me just say it again. Don't play without wait for a following year. Once you hit 70, take your first required distribution that year. Understood? Just take it. I'm 7 years old. I need to take a distribution this year. Get it done. And then you'll be just fine. Okay. In fact, what I'll show you is not only be just fine, it'll actually be more probably won't show in this video, but probably more beneficial to you from a tax perspective. So just keep that in the back of my mind. You can click on my playlist for taxes and RMDs and all that to kind of get a gauge where I'm coming from. At the end of the day, just don't mess around with that. Just play it for what it is. At 70, start taking your required distributions. All right. So now you're 7 years old. And your IRA balance on December 31st of the previous year. I cannot stress this enough. People always ask, what is my RMD going to be? Well, it's based on two things, your age, and it's based on your account balance from the previous year. So if it's February 24th and you're 7 years old, we know for a fact what your RMD will be. It doesn't matter what the markets do. Henceforth, nothing matters because the markets where the value of the account is determined by what the market value was on 31st of December the previous year. So again, going back to me, if I'm taking my first required distribution in 2035, the market value of December 31st, 2034, no, 2040, I keep 35 when I turn 65. 2040 is when I take my first RMD. The market value of the 2039, 31 December 2039 is what determines the amount of my account balance from which I have to divide a number into. I'll share that in just a second. So let me go over that because I just confused myself. I hit 7 years old in 2040. I say, let's just say it's February 24th, 2040. I'm like, oh man, I think I need to take my RMD, my required minimum distribution. What is it going to be? Well, simple. I know that my RMD is based on my account balance from December 31st of 2039. All right. Even if the markets fall 20%, it doesn't matter. My RMD is based on what it was 2 months previous or 3 months previous or whatever date it is that you're deciding to take your RMD out. You know for a fact what your RMD is going to be that year. It doesn't matter. Anything over those 365 days in that calendar year, nothing changes. Your RMD amount will never change. It'll always be the same for that year. So let's give an example. Well, and then on top of that, so let me go back to this. You got to take your balance from December 31st of the previous year. Just let me type in here. No. Okay. So I'm just saying I have $100,000 in my IRA. Distribution period from the table below for your age on the birthday of this year. All right. So my age is 70. My distribution period is 27.4. So I take 100,000 right here. I put 27.4 and then I divide 100,000 by 27.4. It's going to be roughly $3,600. Divide by 27.4 and it's going to be $3,698. So it's basically 33.7% in the first year. Okay. So if you can kind of think that out, 3.7%. And how do I know that? Well, I just take 1 and I divide that by 27.4 and I get 3.7% exactly. So this is a divisor amount. I just wish they'd tell you the percentage, actually. It'd be a whole lot easier, but they don't. So they say you take your account value at the end of the previous year, you put that number there. You come down here, what's your distribution period amount? You put that number there, and you divide it. You divide 100,000 or whatever your account balance was by the distribution period, in this case 27.4, and I have to take out $3,700 by year end. If I don't, I will have a penalty of 50% of that $3,700, which is what, that $1,850, $1,850. And again, that's just on $100,000. It'll be taxed more, penalized more and more and more as my account grows. On top of it, I still got to pay income taxes on that amount as well. So there's no reason to mess with your stupid RMDs, because if you forget it, you're going to pay tax on it anyway. But in top of it, you're going to have to pay a penalty on the amount you forgot to take out because the IRS wants their money. So just take it out. Pay the stupid tax and be done with it. And don't wait till the end of the year. I'm going to be getting that here in a second. All right. So let's keep going. Questions. All right. So now I'm going to maximize it. Now I'm 82 years old. And let's just say I have $200,000 in my IRA for simplicity. So again, I have $200,000. I put it right there. The balance at the end of the 31st from the previous year. So let's say on December 31st, we'll use this 2050. I have $200,000 in my IRA. Now it's February 24th, 2051, but my IRA dropped to $160,000. All right, now I'm 82 years old. I'm just throwing that number out there. So I have a distribution of 17.1, distribution period of 17.1. Essentially, that's what the IRS thinks your life expectancy will be, rightly or wrongly. So I take my $200,000 and I divide by 17.1. Which means my distribution amount would be $11,758. $11,758. But I can hear you saying right now, but Josh, my account is only worth $160 today because the market fell 20%. Doesn't matter. All that matters is the account balance at the end of the year, the previous tax year. 31 December, the previous year is all that matters. It doesn't matter if your account went up to $1 million, if it went down to $10. It does not matter. In fact, this happened where in 2001, 2, and 3, Bush signed a law because the markets were falling so dramatically that people didn't have to take an RMD simply because they were pulling money out in an account that was up here from the previous year, but now it's gone down here. And then happen again and again, and then happen again and again. So they signed a bill, this temporary bill says you don't have to take RMD out because you're going to pay tax on account value that wasn't anywhere near what your portfolio is worth anymore. Should they have done that? I don't know. I mean, it's water on the bridge now, but at the end of the day, it was such a big deal. People were paying tax on money they no longer had because the markets fell off a cliff that the Bush and I guess, it was Republican Congress at that point, did give some reprieve to taxpayers in that regard, not have to take RMDs while the market was getting hammered. All right, so basically now let's go to 94. Now 94. Oh, actually, let me just tell you. So 17.1, we take 1 divided by 17.1 divided by 17.1, and now this distribution percentage is 5.85. So 3.7, 5.85. Now we're 94 years old. Let's say we have 300,000 in our IRA. So we have 300,000. Divide that by this amount here, 9.1. And we're going to have to take out $32,967. $32,967, which is 9.1, 11% of your overall portfolio. All right, so that's how RMDs work. The initial stage of required distributions are actually quite low. So most likely, unless you're invested very, very conservatively or unless the markets collapse, you'll still be adding capital to your portfolio unless you take out more than you're making. But generally speaking, just from a required minimum distribution, you're going to take your minimum out, which is 3.7%. The next year, right here, 26.5. 1 divided by 26.5 is 3.77%. 1 divided by 25.6, 3.9%. So basically the first 10 years, you're taking out probably less than the growth you're getting on your portfolio, which means your portfolio will most likely be bigger here and even up here than it was with your RMDs because you're only taking out the minimum. Now, again, you can take out more if you want, and sometimes you should. But at the end of the day, if you're only taking out the required minimum distributions, you're probably going to add to your portfolio. So that way, when you start hitting these ages, your portfolio will be bigger than what it was here, and you're going to have larger and larger distributions. And again, this was, I think I said 5.8. I think I said this was like 10.8 or something like that. I can't remember. But off the top of my head, not off the top of my head, but as you start getting older and the portfolio starts getting bigger, you're going to start having larger and larger distributions. Now, the point about that is these numbers don't change if you're a surviving spouse. They're still applicable to you. So what happens is, let's say my wife and I are both the same age, and I die at 91 years old, and I'm supposed to take a distribution period of 10 point, my divisor is 10.8, which is a distribution percentage of 9.3. I have $300,000 in my IRA, divided by 10.8. That means that, 300,000 divided by 10.8, which means I have to take 27,800 out of my IRA for mandatory distributions. I die, I leave it all to my wife, Charlotte. She still has the same amount of money to take out. But what happens to her tax bracket? $27,700, $27,800 for me and her as we're married filing jointly. That is only a little bit above our standard deduction. Our standard deductions are $26,600. So you only have to pay $1,200 of taxable income, not including Social Security at this stage. That's it. Now, Charlotte still has to take the same amount of money out, $27,800. But now she only has $13,300 of standard deductions, which means immediately her taxable income is going to be $15,000 something, $15,500. Where both of us, our taxable income was only $1,300. Now it's going to be $15,000. You see, that's why we want to start using these distribution periods when they're lower, start pulling more than we need to when we're married filing jointly, so that way we don't leave our surviving spouse with a proverbial widow's tax trap, which I always talk about. So that's the RMD, Uniform Lifetime Table. The schedule of the publication 590 has all kinds of other things where they talk about if you're inheriting, does it go down? If you're inheriting the asset, why is it not going down? Let's see. Well, it's not going down for me for some reason. They got another page. Oh, I guess I'm at that last page. But they have other. I'm looking for. other tables in here. I'm looking at table 1, which is single life expectancy, which is used by beneficiaries. It's not your spouse, the non-spouse beneficiary. So a non-spouse beneficiary using table 1. Yeah. Oh, actually a nice little thing here. They give us a nice little example. I like that actually quite a bit. That's fantastic. I wish you just put your own information there, but it's still pretty good. So again, it's a uniform table we want you to look at for most people. That's table 3, uniform table. And how you know is you just whatever, there's 3 tables on there, if not more, but 3 primarily. And what you know is once you hit 70 and a half, you got to start taking the amount out divided by 27.4. So have 27.4 tattooed on your brain. That's the right table. For your surviving spouse, who's less than 10 years younger, she'll use the same table. For life, this is for single life expectancies for beneficiaries, table 1. So lots of different tables in here, but you just really need to remember table 3 for the most part. So hope this has been helpful for you. Don't forget to comment below. Thumbs up are always helpful for sure. Subscribe. Lots more discussions on required minimum distributions. What's the best way you can maximize your RMDs? Should you even wait until you're 70 years old? The answer is no, but we'll get into that later for different episodes and whatnot. So don't forget to subscribe and hit the notification bell to be notified of future content. We'll see you next time on the Heritage Wealth Planning YouTube channel. Thanks, guys.